back into the world of goodwill in chapter 10. I know that, you know, I know this time of the semester, it's always like this, like around week 5, people start getting a little bit maybe tired, and there's a lot going on, and you have tests and stuff in other classes, and you've got work and life and so on. So, you know, I understand that sometimes the classes get a little bit quiet, but I do ask you to engage as much as possible and you know, ask questions, because some of these concepts are a little bit tricky, and I want to make sure that you have them solid. Like I said, the same intermediate accounting that we're doing now is the intermediate accounting that you'll be doing, you know, at your 4-year school, is the topics that will be covered in the CPA. All right, so you want to make sure that you're actually focusing. So last time we spoke about goodwill, you know, the example was Facebook buying WhatsApp, and they had $15 billion worth of goodwill. And we said, you know, that goodwill is the excess, it's the extra money that a company pays when they are buying another company over and above the fair value of the assets and the fair value of all the liabilities. And then we did an example. It was example 14, where the one company paid $700,000 to buy another company. Let's get the names, because I can't remember them. In fact, I'll just look for, I've got the document over here. So Winans bought Omont. So Winans paid $700,000 to buy Omont. Omont's fair value of assets was $800,000 as given in the question. And then they just said that the liabilities book value was $200,000. They didn't say anything about fair value. But we know that if the question's silent about the fair value of the liabilities, the fair value and book value are the same. And so we said, how do you calculate goodwill? It's the excess of the purchase price. So there's the purchase price over the fair value. That's fair value of the net assets. Net identifiable assets is assets minus liabilities. So 600,000 was the fair value of net identifiable assets. So we end up saying that the purchase price minus what we actually got for the company, right, for buying the company, 600,000, the extra that we're paying, that 100,000 represents goodwill. It's an intangible asset. It's an indefinite life intangible asset. So we don't amortize it. We end up testing it for impairment when there are indicators of impairment. And we'll talk about impairment testing in chapter 11. And so then they also asked us in part B to do an acquisition journal entry. When you purchase another company, you acquire all the assets, you assume all the liabilities. Goodwill is an asset that is created as part of the acquisition, part of the purchase, and then you credit cash with the amount of cash that was actually paid, right? Cash is a fact, cash was paid, so we're going to include the actual amount there. So that was where we left it. And I thought it might be helpful to also just to kind of reinforce how these goodwill questions could show up, to go through an example that's in the textbook on goodwill. So this looks much more intense than it actually is, so don't worry. But this is in your textbook. Let me see, page 524, illustration 10.8, goodwill. I wanted to just go through this because it's showing the same concepts, except that the assets are actually listed as individual assets, and sometimes the questions are presented that way. So I thought I'd just go through it with you. So the Smithson Corporation acquired all of the outstanding common stock of the Ryder Corporation. So Smithson is the purchaser, Ryder is being acquired in exchange for $180 million cash. So this is the purchase price, right? So remember, goodwill is the excess of this purchase price over the fair value of the net identifiable assets. So we have the purchase price, we need to figure out what's the fair value of the net identifiable assets. Smithson assumed all of Ryder's long-term liabilities, and they say that the long-term liabilities have a fair value of $120 million. So that's one part of the net identifiable assets. The fair values of all the identifiable assets are as follows. So they've got accounts receivable 50, inventory 70, PPE 90, and a patent of 40. So altogether, the fair value of the identifiable assets is $250. This thing is just going to have a field day with me today, it seems. The cost of goodwill resulting from the acquisition is 50 million. That's what they tell us, but let's see how they calculate that. You've got the purchase price or the fair value of the consideration given, which is just a long way of saying the purchase price. From that, you subtract the fair value of the identifiable net assets, which is the 250 of assets minus the 120 of liabilities. That gives you 130, right, as the fair value of the identifiable net assets or net identifiable assets. So 180 minus 130. So you paid 180, but you got stuff to the value of 130, right? That gives you goodwill of 50. So that's, again, you can see, even though this example is a little bit more involved, in our example, we just got this final number. We didn't get a listing of assets, but it's the same process, right? What we did over here, this business over here is the same as what we are looking at over here with the 50. And then the journal entry to record the assets. Yes, we don't just have one number that says assets, but all these assets are just the debit. You just take the fair value of all the assets and plug it in. The new asset goodwill that was created, you take the 50 over there. The liabilities are going up on the credit side because when you purchase the company, you assume their liabilities, 120, and then you paid 180 for cash. So that's the acquisition journal entry. Okay, so this is page 524, illustration 10-8, gives you another nice working of how to calculate goodwill. So, you know, when Facebook was looking to purchase WhatsApp, when Amazon was looking to purchase Whole Foods, etc., this is the type of calculation that they would be going through. The hardest number to come up with is this, the 180 million. And the reason I say that is that would be, you know, a valuation of the company, and you'd have to get, you know, experts in to try and figure out what the company is truly worth, outside of just what its assets and liabilities are worth. Like, what should we really be paying for this thing? And so, you know, that number is hard to calculate. You don't have to calculate that, obviously, for our purposes. This is the type of number you would calculate if you become a finance major. You would do what we call a discounted cash flows or earnings multiple or something to come up with a number that is, you know, some type of valuation of the company. Okay, so that's another example of how goodwill is calculated. As I said, it's an indefinite life intangible, meaning there's going to be no amortization, and it will just be adjusted if it's impaired. So there was a whole big deal, you know, a year or two after Facebook purchased WhatsApp, because people were like, well, does this goodwill have any value? Because, you know, WhatsApp isn't actually generating revenue. So, you know, shouldn't this goodwill be impaired? And, you know, Facebook was saying, well, there's all these other benefits to owning WhatsApp that may not yet be monetized, but they're there. So you can imagine that, you know, the valuation of a company can to some extent be quite subjective, and the goodwill, you know, is a number that is dependent on that valuation. So when it comes to testing for impairment of goodwill, it's kind of a big deal, because you're basically saying that, you know, I overpaid, right, for a company because I believe that there's extra value in there. But if that value doesn't materialize, then you've got to take a massive hit to your income statement as a loss on impairment of the goodwill. And you can imagine that no one really wants to do that. So one day when you're auditing, you're working for KPMG or EY or Deloitte or BDO or PwC, you know, and you see goodwill on the books, and maybe it's goodwill from an acquisition, you should always be asking for that asset, right? Back to the definition of an asset. The future benefits, right? It's a resource owned or controlled by the company from which future benefits will flow. You know, do we still expect $15 billion of future benefits to flow from the WhatsApp purchase? now that we've had this asset for 7 years, we have a, a good idea of what has flowed already. Okay, so when you guys are doing all your auditing, you will, ask the auditors have to ask those questions. The CPAs are asking those questions to the companies. And then there is this scenario called a bargain purchase, where it's possible that a company ends up paying less for the business, the acquisition, than the fair value of the net identifiable assets. And this could be because there's some weird situation with the company. So I'll show you what that means. Let's assume instead that I don't know why it's so hard for me to remember this name, that Winans paid $450,000 for the acquisition. Okay. Calculate goodwill. So now all you're doing, so I'm going to bring this all down, right? Just copy and paste it. But your purchase price is going to become much less, right? 450,000. Do you see how that becomes negative? This is what we call a bargain. You know what a bargain is, because you've gone shopping and you're like, oh, this is a bargain. It means that it's really cheap, right? A bargain purchase, or sometimes referred to as negative goodwill. It means that for whatever reason, based on something to do with the company, it could be that the company really just has to sell. I mean, if you think about COVID times, this is probably like a typical thing that could be happening to people, where they just can't keep the company going. And even though their assets are highly valued and they do have a high fair value of net assets, they can't get a buyer at a price that they want. So they end up being forced to sell, at a price that is less than what the business is worth. And so the purchaser gets a bargain purchase, and this will be recorded. So this negative goodwill amount is recorded as a gain, right? You can imagine that. So it's a credit instead of, when we had this previous journal entry where we had this debit for goodwill, now it's a credit of a gain on the it's not for goodwill, right? I mean, obviously by nature, goodwill is an asset, it's a debit. So what you're gonna do here, just to kind of close the loop, is you're still gonna record the assets, right? Everything is the same, right? You're still gonna record assets of 800,000. There's excuse me, there's no goodwill to be recorded. So you're going to go with cash 450. You're going to still put in the liabilities 200, and then you're going to just have a gain on the purchase of 150,000. So that's what, and that should add up. Hopefully, yeah, that does add up to 800,000. So that's what it looks like if you end up paying less for the company than the fair value of the net identifiable assets. All right, and that's a bargain purchase. So that's goodwill recognition and the bargain purchase. Like I said, when we get to chapter 11, we will go into impairments. We're not there yet. Does anybody have questions on the journal entry to recognize goodwill, or on anything to do with goodwill? Because we're getting ready to move away from that topic. So questions, I'm here for questions.
Could you wait a second, please, so that I can write down?
Absolutely. Thank you for saying that. I can give you guys all the time that you need. Is that enough time? Are you good?
I'm good, thank you.
All right, you're welcome. Okay, so there are a few, I think it's just two more questions on intangibles that we can go over for our work here. And it's number 11 and number 12. Number 11 is to do with a customer list that is also considered an intangible. And number 12 is a patent. Excuse me. So let's go through and read number 11. I'll do the question with you and we'll see how it goes. So assume that Green Market Inc. acquires the customer list of a large newspaper for $6 million on January the 1st, 2012. So let's just think about the scenario here. Green Market Inc. seemingly is some type of supermarket, and this large newspaper likely has people who subscribe to the newspaper, so they have the names and addresses of individuals. And I guess, you know, these days it's becoming a little bit more difficult for companies to do things like this because people will opt out and people don't want their information sold and so on. But if you've ever received, you know, what we would probably call junk mail in the mail from some, you know, company, and you're like, I definitely have never signed up, you know, to this company for their mail, it's likely that your information was probably either shared or sold by some other company that you do buy from. They shared or sold it to this, you know, new company. So that's what's happening here. There's a whole lot of people on a list at the newspaper who are customers' names and addresses, and the newspaper is selling that list for $6 million to this company, Green Market Inc. And so you've got, right, the customer database includes name, contact information, order history, demographic information. Green Market expects to benefit from the information evenly over a 3-year period. And by benefit, they mean that they're going to generate some type of revenue because they're expecting, I guess, to create new customers from this purchase. Green Market determines that it can sell the list for $60,000 to another company at the end of 3 years. So then, you know, the names are going somewhere else after that. Prepare the journal entry to record the customer list. So what's happening here is Green Market is acquiring an intangible asset, which we'll call customer list. So the asset customer list will go up on the debit side, and the assumption is that they're paying in cash because the question doesn't say anything else. So cash will go down on the credit side. So I know the examples are out of order, but when you guys are using this document, you'll be able to, you know, see that the topics are generally, you know, together. It's just that some of the examples are not necessarily, I guess even on the sheet, they could be in a better order. So customer list is the intangible asset, right? I'll just put it here. So when you're looking at this, you remember. And that's going to be 6 million. And then you've got cash. It's as simple as that. Cash is 6 million. So what about the 60,000? Can someone tell me what is the 60,000? It said that Green Market can sell the customer list to another company at the end of the 3 years for 60,000. What is the 60,000 and why is it not included in the purchase price? Anybody? So 60,000 is the amount, right? That they can sell it for. What does that represent? And why isn't it included in the purchase price?
Estimated purchase price.
Well, it's what they could sell it for, the 60,000. So we had this before and thank you, John, for for saying something. We had this before when we were talking about the mine. I don't know if you remember the mine. This example, not this one, the one before, over here, when they said that the mine could be sold for 160,000. That is also referred to as, what is going on with this thing today? That is also referred to as salvage value, right? Salvage value, the amount that you could recover from selling the asset at the end of its useful life. So, so the $60,000 is salvage value, and isn't included in the purchase price, but is deducted from the purchase price to calculate amortization expense. This goes back to, how do you calculate depreciation or amortization? It's basically to get to the amortization base. If you see, this is going into, chapter 11 work, but I just want to take this to its end, right? You see here that the useful life of this customer list is 3 years. We could sell it for 60,000. So the way the company would do the amortization calculation, just so you see where this information fits in, is that they'll say cost. This might ring a bell to you guys. Cost 6 million, salvage value 160,000. So this is going to be what we would call the amortization base. Okay. We don't amortize the 160. Sorry, I put 160 instead of 60,000. Sorry. We don't amortize the 60,000 because we are expecting to recover it, so we don't have to expense it in our books. So the amount that we will base amortization on is 5,940,000. The useful life is 3 years, meaning that we can use it obviously over 3 years. So the annual amortization expense, if you were asked for that, that would be like a part B in this question, but we don't ask it here because we're still dealing with acquisition. The amortization expense would be this 5,940 divided by 3. Okay, that's how the 60,000 comes into play. It doesn't come into play with the cost, but it comes into play when you are calculating the amortization expense, right? When you're expensing the asset based on how you are using it. Questions there for this quick foray into amortization or the customer list journal entry?
I'm good, Professor.
So you're okay now after what you were saying? Okay, so I'll just put here, what about the 60? Okay. So number 12 is also still part of intangible. So I'll just run through that with you guys as well. The patent. Now notice, right, how we have all these different topics. You've got to be careful of these chapters because we've done the cost of property, plant and equipment type stuff, land, buildings, whatever. And now we're doing all these intangibles, including goodwill. We'll move on to lump sum purchases in a minute. Then, and then there's still a few more topics after that. So you want to keep your wits about you here to make sure that you are, okay with what is being said. So assume that Harcourt Inc. incurs 180,000 in legal costs on January the 1st, 2012 to successfully defend a patent. The patent's useful life is 20 years, amortized on a straight line basis. Prepare the journal entry to record the legal costs. So this is purely a lawyer's fee. This is not even the acquisition of the patent. So it seems like, if you just think about this under normal accounting circumstances, you would think that this is probably just going to be legal expense, debit and credit cash, but we have to be careful because if you go back into the theory about patents, you'll find that it actually says for a patent, the company can capitalize costs incurred in connection with securing a patent, as well as attorney's fees and other unrecovered costs of a successful legal suit to protect the patent. So in the question, it said that the legal suit was successful. If it had been unsuccessful, you wouldn't be able to capitalize. Remember, capitalize means that you make this expense into an asset, make the payment into an asset, not into an expense. So when we go back to this question, we now realize that based on the theory that we actually need to debit patent for the 180,000, not debit legal expense. Okay, so that's something to look out for. You need to know that when you have a patent, that if you do have to go to court, and I mean, we saw this a lot with like Apple and Samsung and some of these other tech firms, they go and fight in court for sometimes for years about patents around technology, especially with the phones, and in the end, if they are successful, whoever is successful between the two parties that are fighting it out will actually be able to debit all of those legal fees, which I'm sure are astronomical. They'll debit it to patent. All right, so let's go in here and do example 12. You already know the answer. We're just going to debit the patent and credit cash. So it's not, the journal entry in and of itself is not hard. What's hard is knowing that you are allowed to capitalize legal fees when you are defending your patent. All right, so patent, not legal fees. That's the, it's going to be that kind of day today, right? That's the answer for number 12. Okay. And so we move on. That kind of concludes what we had to do around intangibles. And I'll move us on here to something called lump sum purchases. Lump sum means you're paying, some big amount of money for a whole lot of stuff. And then you have to figure out afterwards what cost to assign to each of those items. So if you've ever been to a yard sale or you've tried to strike a bargain with someone at a market or something, sometimes they'll say, okay, you can take this group of things and give me $50 or whatever. I take this box of stuff and I'll take, $20 or whatever. That's a lump sum purchase because you're just paying $1 amount and you're getting multiple things in exchange. Now, for a company, the issue with that is they can't just record the lump sum as, debit staff and credit cash. They actually have to break up the debit between the different types of assets that they purchased because there are different rules for the assets around, depreciation and impairment and so on. So when we buy a whole lot of assets for a single sum, the total cost has to be allocated. And how is it allocated? This is where you want to be sure you understand what's happening. It's allocated based on relative fair values. So relative means one number in relation to another, and fair values would be given in a question. So we're saying, okay, I bought these 3 things at the yard sale. I paid $100 for them. In order to figure out what the cost of each item is, I have to figure out the fair value of one item in relation to the fair value of all the items that I bought together. So it's a little bit of a process in real life. I guess, in the questions that we do, we get given this information. But if you were doing this in real life, you would have to figure out what the fair value of the stuff is. So to determine fair value, a company should use the market income or cost valuation approach. So again, this is, calculations outside of the scope of our work, but someone would have to come up with a fair value at the company. And when you do the fair value, you have to use the highest, you have to assume the highest and best use. What they mean is, you can't say, oh yes, I know that this is like some 5-star engineering, biomedical equipment, but we're going to use it, as a footstool or something. And so we're going to base the fair value on, sitting on it as opposed to use, I mean, it's an extreme example, but sitting on it instead of like actually using it for medical testing, right? You have to assume the highest and best use. And this is being said so that people don't manipulate the numbers in trying to say that something will be used in ways that it just shouldn't be used, so that they can, change how much of the actual cost of the lump sum purchase is assigned to that item. All right, so that's lump sum purchases. I'll do one example with you, and then there's another example that you guys can do on your own, and someone can walk us through that answer. All right, so the first lump sum example is number 4, and that's the one I'll do, and then I'll leave you guys to do number 15. I'm sure you'll be fine. You guys are, despite the silence, I know you guys are smart. So Mojave Inc. This is number 4 now. This is a lump sum purchase, okay? Mojave Inc. purchased land, building, and equipment from Laguna Corporation for cash payment of $315,000. So 3 things, 1 payment, right? And it's 3 very different assets. So you can't just debit assets and credit cash. You have to separate them out, because remember, even land is not going to be depreciated. The building will probably have a much longer useful life than equipment, so they all need to be separated out so that you can account for them properly. The estimated fair values, so there's the whole notion of relative fair value that I spoke about. The estimated fair values of the assets are: land is $60,000, the building is $220,000, and equipment is $80,000. At what amount should each of these 3 assets be, be recorded? All right, so let's go in here. This is example for lump sum purchases. All right, so the first thing that you probably want to figure out is, what are the relative fair values? So what we mean by that is, right, what's the fair value of the land in relation to the total fair value of buildings in relation to total value, and so on. Okay, so what I'm just going to do, and I mean, there are various ways to do this. This isn't necessarily the only way. I'm just going to list all the fair values from the question. Sorry, I should have, for those who want to follow along with me, let me give you a minute if you need to take a picture of the question, or jot it down, or jot down the key items. Just take like 30 seconds to do that. Okay, so we go with, land is 60,000 for the fair value, right? The building is 220,000, and equipment is 80,000. Make sure I'm putting the right numbers here. All right, so now we want to know what's the total. Sorry, that's not where I meant to do that. So the total fair value is 360, right? 360,000. So all you got to do now is just say, what is land as a percentage of the total, right? So it's about 17% or 16.67, and but I told the thing to do it. Okay. So this is 16.67, 61%, and these percentages are not, pretty, but you can round to 2 decimals and so on. So you're just saying 60, right? If anyone missed the 60 over 360, 220 over 360, this is relative fair value, right? And 80 over 360. And now you know with this purchase price, right? The purchase price is 315,000. This is given in the question. This is not something that we needed to calculate. Now, what we're trying to see is what is the cost of these items based on using the relative fair values, right, for the calculation. So for land, you're going to say, and let me actually just take the given word out here so I can use this number as it stands. Okay, so for land, what you're going to say is 315,000 multiplied by the 17%, right? And so it comes out to 52,500. That's now going to be the cost of the land that you'll put into your books. Buildings and equipment. Right, we go through a similar process. We say 315,000 multiplied by the percentage relative fair value, 192,500. Right, and then the last one is the equipment multiplied out with its percentage is 70,000. And so obviously these three are going to add back up to 315,000. And so you know that you've now allocated the cost of each of these, or the total cost against all three of these assets. And again, this is 315,000 times the 16.67% and so on, right? So it's a fairly, I think, straightforward calculation. I don't know if anybody has any questions here for me about that. Okay. So let's have you guys do your your own question, and we'll see if you can come up with a similar, hopefully a similarly good response here. Looking at number 15, Bell Inc. So I'll read it with you and then I'll leave you to work out what the cost of the CDs will be. So Bell Inc. buys 1,000 computer game CDs. So right, 1,000 is the number of CDs, the lump sum, from a distributor who is discontinuing those games. The purchase price for the lot is 8,000. So that's the overall cost. Bell will group the CDs into 3 price categories for resale as indicated below. So you can see here that group 1, this is basically the fair value, right? That for group 1, the fair value of the CDs is 5. For group 2, it's 10, and for group 3, it's 15. So you basically have to follow a similar approach to what I was doing before to divide up this cost of 8,000 between the 3 groups of CDs based on their relative fair value. So I'm going to give you a minute for those who have not yet accessed the questions, give you a minute to take a picture of the question or do whatever you got to do so you have the question in front of you, and then I'll flip back to where I answered the previous question just to remind people on how I did that. So let's take 30 seconds here to give you a chance to take a picture of the question or download the question. Okay, and I will now move to the previous solution to give you an example of how we did that. And let's go until, let's say 11:42. And then I'll ask for someone to volunteer I know it's the worst, right? But just volunteer and tell me how you walk me through your thinking around the answer. Okay. So by 11:42, I need someone to raise their hand and answer this question for us. Why not? And then I need a volunteer.
I can do that, Professor.
Thank you. All right, my apologies. I think it was Gion who was speaking. I realized that two other people had actually already raised their hands, so I'll take it in the order of raised hands, which means that Sharon, you were first. Are you raising your hand to answer the question? Or for something else?
Yes, Professor.
Okay, so why don't you go ahead? The other two people who raise your hands, thank you. I may call upon you at a later stage during the class, but let me just be, I guess, fair and go with whoever raised their hand first at this point. All right. So Jaren, take it away here for example, 15. What were you thinking in terms of answering the question?
So we have to first define group one, cost of CD,
Okay.
then group two, and then group three.
Okay, so I'll just do 1, 2, 3 like this. Okay.
We don't see.
Hmm?
Did I see your screen? Oh wait, Professor. Okay,
Yeah.
Professor. Yeah.
Mhm.
So first one, group one is sale value is 100 equal 5, so 500.
Okay.
Then
Mhm.
sale value of three group, I added the three group sales
Okay.
value. So 100 equal to 5, 800 equal to 10, 1000 equal to 15.
Yeah. Okay, I got you. And then you
So
sum those up.
yes,
Then you
Professor?
added it together.
Yeah.
Yeah. Okay.
Then cost algorithm of group one is 8.
Okay. Let me do the percentages. Then you did the percentages, right? Is that what you did?
No.
No. Okay, that doesn't sound right. Okay. Sorry, I didn't mean to put words in your mouth. So what do you want me to do next?
So we see here the purchase price of the lot is 8,000. So
Okay.
cost allocated to group one, 8,000 equal to 5,000 divided by 10,000. 5,000 I find sales value and 10,000 is sales value of the three group. So
Okay.
I find
So
4,000.
okay. So let's take a step back here. So are you comfortable? Can you see my screen?
Yes, Professor.
Okay, so I'm not I want to make sure that we're ending up on the same answer. I did it a little bit differently, but I'm fine with following what you're saying. But I'm just struggling to understand how you got to your percentages. So I know the purchase price of the entire lot is 8,000. So we obviously need to end with 8,000 when we're doing the cost, right? And
Yeah.
that's fine. And I'll even just put 8,000 here, so we know the final balance is for the cost is 8,000. I guess what I'm What I'm
So I
struggling with
find
is
4,000 and then I equal to 10,000, then I find 4%.
okay, so that's where we're different. So let's be clear here. This is the fair value, right?
Okay.
The 5, the 10, the 15. So multiplying out with 100 or whatever, I mean, it's going to end up causing a weighting in the fair value that is not going to give you the actual percentage that you need. What you need to do is add up the price as the actual fair value per item, right? And so you're going to say that this is now $30 is the total relative fair value. And each of these items, right? The 5 in relation to the 30, the 10 in relation to the 30, the 15 in relation to the 30. That's how you're going to calculate your percentage.
Okay.
This piece will distort the answer because you'll just see that if you do this 5 in relation to 10,000, it actually throws the situation off, because in order to do that, all of these numbers should have been the same and they're not. So what I'm going to do is take this away because we won't really need it. Sorry, we won't really need it right now. And I'm going to bring the cost across and I'll show you now what I mean. So for the percentages, I'm going to say 5 out of 30. Okay. So we're again with this kind of 16%. And then, and stop me if I'm not making sense. I think this is probably I thought I'm saying enter, but it's not bringing the thing down. So we can't, calculate relative fair values if the number of items is not the same. When we were doing this question, it was just one of each, right? So it's fine. With this, there's one thing as 800. So if you multiply out the 800 by the price, it's going to give a totally distorted answer. So when the numbers are different here, you just use the price as the relative fair value and then do the calculation of the percentage of this price as a percentage of the whole. Do you follow, Jaron?
Yes, Professor. I
And
see
then,
that.
yeah, and then all you have to do is say 8,000, right, times the 16. And so these group 1 or whatever is 1,333. And group 2 is going to be, right, 8,000 times. There are other ways to set this up. Your page doesn't have to look like mine, but we do have to come to the same answer. I can't get to the 8,000. We do have to come to the same answer. So if you guys got to the same answer without, this sheet set up this way, not a problem. I just want to make sure that you understand that to calculate fair value when there's a different amount of items, don't multiply out the amount by the price, just work with the price itself so that you're getting the actual relative amounts. Because remember, all of these items are CDs, right? They're all CDs. So you could just work with the dollar price of each CD item. Jaron, I hope I didn't
Yes, Professor.
drive you crazy. Okay.
No, it's okay. I understand now.
Okay. So next time, if it's just land building equipment or something like that, you don't have to worry about the multiplication. But if there's a whole lot of different stuff and there's different numbers of those things, then you do have to worry about not multiplying it out. Just work with the dollar amount of each item. Okay.
Okay,
Anybody? Thank you.
Sorry, how to calculate percentage? Can you explain, please?
Yeah, sure. Sorry. I probably went too fast through that. Let me make an extra little column here. And then I'll put I've now messed up. Have I now messed up everything? No, I have not. Okay. So all you're doing is 5 over 30, like the other one. 5 over 30, 10 over 30, and 15 over 30. Because we're only working with the actual prices. We're not working with the price times the quantity. Because if you multiply by the quantity, it's not going to give you a proper relative fair value because group 2 has 800 CDs. So it's going to make the group 2's percentage of fair value, relative percentage of fair value, much higher than it actually should be based on just individual prices.
So it doesn't matter for the number of cities.
Yeah, so exactly. Don't go by the number of CDs because you're going to mess up your percentage. You got to go by the price of the item. The reason we didn't worry about that over here on this previous example was we only had 3 items, right? So you didn't have to multiply the price out or anything like that. So when you're talking about relative fair value, you're talking about the fair value of one of that thing, not of 100 or 800 or 1,000, just one. The fair value of one of group 1 in relation to the fair value of one of group 2, group 3 in relation to the total fair value. So just one item, not hundreds of items. And
Understand.
then
Thank
in
you.
the answer, you multiply by the hundreds, however many hundreds of items, you know, you make sure then that the hundreds will come up.
I see. Thank you.
All right. Anybody else? Questions? It's a little bit tricky because, you know, group 3 only has 100 CDs in it, so it doesn't look like it should really be half of the price of the lot, but because of this relative fair value thing, that's how it ends up being. Okay, so here we break. Let's break until 12:02. Remember, during the break, or after the break, you want to tell me any questions you may want to ask for the guest speaker, and then we'll take it from there and see what else we're going to do for the rest of our time together. So 12:02. I'm going to stick around during the break in case people have questions for me. Aaron, are you asking me a question? Or is your hand still up from before? Okay, we're back from break. Remember I said that when we come back from break, I'll take a few questions that people may have for Professor Maharaj. Just to have them, just in case, people become so engaged in what she's saying that you forget what questions you may have had. Apologies that I have something in my mouth. I have a sore throat today, so I'm trying to soothe my throat because the talking doesn't help. So I'm just trying to use something to soothe my throat. Anybody want to call out some questions that you or a question that you think you may want to ask, or a topic that you want to talk about? We'll literally only take until maybe for 5 minutes or something. So just throw out anything that you think you may want to remember to ask the speaker about effective communication. Or put it in the chat if you don't feel like speaking out loud. Anthony, did I see you saying something? Or am I imagining things? Okay, so we're at 12:15. Are there any questions that have come up for anybody from reviewing your chapter 9 homework? Again, the majority of people basically got 100%. So I just want to close the loop here to make sure that there isn't something that you eventually got right. Excuse me, but you don't know the true reasoning behind it. All right. Seems like most people are solid. What I'll do is maybe leave 5 minutes at the end again in case something strikes you as necessary to follow up with me. All right. So for the remainder of this chapter, we're going to be dealing with non-cash acquisitions. So the company is getting some type of asset, but they are not paying cash for it. And in this section, I guess the two bigger topics are exchange of non-monetary assets, and interest capitalization. So if you're kind of marking off which areas are important, interest capitalization is a pretty big topic. We probably won't hit it today, which is fine because we're still doing great for time. But interest capitalization is something that will definitely come up in a major way on the next test. And then, this exchange of non-monetary assets comes up all the time in our work, and it's got a lot of like rules attached to it that get a little bit involved. So when we get to that in a few minutes, I'll kind of go super slow to make sure that we're all following together. But in the meantime, there are three other topics in this non-cash acquisition that are very small, and we'll kind of just fly through them. I think only one of them I'll even do an example. The other two are not really, they're kind of obvious. So the first one is deferred payments. So the book makes it sound a little bit more difficult than it is. This is basically talking about when a company buys something on account, like when they're borrowing money to buy the thing. So if you look in your book, you can see that the first example over here they show you is, for instance, right, buying a machine using a note payable. This is like a classic journal entry that we've seen before: debit asset, credit the payable. Now, the way the deferred payment situation works is we're saying, under normal circumstances, when a company buys an asset and, they're signing a note payable, the fair value of the asset, in this case, $15,000 machine, is going to be also, the same as whatever's being recorded as the note, because you have, some type of realistic amount of interest that is being charged, and it's all good, right? You don't have to worry about it. Where questions may come up is when there's no interest rate, or when the interest rate is unrealistic. And so at that point, what the rules say is that we would have to calculate, this the amount that we record the asset and the liability based on a realistic interest rate, and possibly even having, some type of present value calculations. Remember, I showed you present value calculations last time from that table and so on. I'm not going to have you do examples in this. I just need you to know that there is such a thing as deferred payments, which is notes payable. Normally, we just record the asset at whatever amount we purchased it for, and the note payable is the other side of the entry. And this is all based on reasonable interest rates. But when no interest rate is stated, or if the interest rate is unreasonable, we are required in practice to find a suitable interest rate to figure out what the interest should have been, and then do a calculation, a new calculation for the present value of the payment, and that's the amount that the asset will get recorded at. Okay, so that's if there's a deferred payment, and this is a non-cash acquisition because you're buying on account, right? Or using notes payable. So you're not actually paying cash. So that's that example. It's more theoretical here than necessarily anything huge that you need to answer. I'm not going to ask you to do any present value calculations. We are already doing that as part of the asset retirement obligation. So that's the first one. The second one is issuance of stock. This is pretty, I think, you would have seen this some time back, maybe in accounting too, but this is pretty easy to follow. We're basically saying that we're acquiring a property maybe or some type of other asset, and in exchange, we are issuing stock instead of, paying cash. And so the rule around this is that you are going to, if the stock is being traded on a stock exchange, you will just use the market price of the stock. If the stock is not being traded on a stock exchange, you'll use the fair value of the property that is being acquired as an indicator of the amount at which you need to record the transaction. And I mean, that's the rule. It's the fair value of the asset that is given up or the asset that is received, whichever is easier to determine. So, in these questions, you're usually looking to see whether the company's stock is traded, and if that's the case, you just go with that. But, there may be other ways to determine the fair value of the transaction. So for this example, issuance of stock, we do have an exercise here, number 9, that we can go over quickly. Right, Fielder Company obtained land by issuing 2,000 shares of its $10 par value common stock. So the land is the asset that's being acquired. It's giving up 2,000 shares, $10, just the par value of the common stock. It's not the market price or the fair value. Remember, par value is kind of an arbitrary amount that is assigned to each stock as to, I guess, create an amount of capital that will not be distributed as a dividend. So 2,000 shares of $10 par value, this is not market value. The land was recently appraised at $85,000. So appraised means that a qualified person actually came and looked at the land and kind of told you what it was worth. And then it says that the common stock is actively traded at $40 per share. So actively traded means that $40 per share is really, the amount that you can kind of depend on. It's not a stock that is listed, but it hardly ever trades. So prepare the journal entry to record the acquisition of the land. So now we're in a little bit of a quandary. Obviously, we know that we have to debit land and we have to credit common stock and so on, but we could either use the 85,000 at which the land was appraised, or we could use the $40 per share for 2,000 shares. That comes up to $80,000. So if I go back up and remind myself, what did the rules tell me? It says the market price of stock issued is a fair indication of the cost of the property acquired. If the stock's market price is not determinable, use the fair value of the property. So since the stock's market price is determinable, we will use the stock's market price for recording this transaction, right? So I'll go in here. This is example 9. And it's going to be a journal entry just to record this land and stock. So we're debiting land, right? And in this case, we are using the 2,000 shares times the $40 per share. So you should be asking, hey, but the 85,000 was more. Why aren't we using that? And as I said, we are instructed in the theory, right? The rules are telling us that we have to use the market price of the stock unless you really can't determine the market price of the stock, at which point you can use the fair value of the land. And so now if you think back to the good old days of stock issuance, you remember that common stock, right? It's a stockholders equity account, it goes up on the credit side. You will credit it with the number of shares times the par value per share. That's how we populate that account. And then obviously debits and credits need to balance, and at this point they do not. So there's the 60,000 extra, and this is that long name, right? Paid in capital in excess of par value for the common, I'll just abbreviate because I'm running out of space, common stock. Okay, so yeah, you had the choice between 85,000, which is the appraised land value, versus the $40 per share for 2,000 shares. We stuck to the $40 for 2,000 shares because the rules told us to do that. And you know, if you forgot this piece, this is a classic stock issuance credit side of the journal entry, right? The rule is you credit the common stock with the number of shares times either the par value, or if there's no par value, times the stated value, or if there's no par value or no stated value, then common stock will just take the entire 80,000. But since there's a par value here, you say 2,000 times the par value, and any excess goes into this. Sometimes it's called additional paid in capital account. If you look at companies form 10Ks, they'll just call it additional paid in capital. But you know, the textbook version is paid in capital in excess of par value common stock. And we write common stock as an identifier in case the company also has preferred stock on its books. Any questions on non-cash acquisition using stock? All right. I'll push on. So many topics, right? Goodness gracious, it's never ending amount of topics in this chapter. So please, I beg you, you know, once you're done with the test, don't neglect going in and starting this homework because it's a lot of separate things that you need to deal with, and you want to make sure that you have a handle on it. So the last non-cash acquisition before we get to the two biggies, which is the non-money exchange and the interest, is a donated asset. So you know, if a company gets a non-monetary asset, so it's not money, some other asset as a donation, the fair value of the asset should be used to record the asset on the company's books. So you debit whatever asset it is, let's say it's equipment, you debit equipment. So it's fair value, right? Not cost, because you, as much as we say we follow the historical cost principle, that asset that's being donated at that point may have been used, you know, all kinds of things could have happened with it. So you go with what it's actually worth today as a representation, right, of the cost of the asset. And then the credit in this case goes to what, and you find this a lot with non-profits, it goes to contribution revenue. So it seems weird that it should go into a revenue account, but this is specifically non-profit accounting that their day-to-day business does involve receiving donations. So revenue is the correct place to put this. It wouldn't be like a gain or anything like that. So this is when we acquire the asset via a donation. When we contribute a non-monetary asset, right? It's an expense. When we're giving the asset away to you know, the other side of this transaction, it's an expense for the company that's contributing the asset, and you have to record that expense at the fair value of the asset that you're donating. And if there's a difference between the fair value of the asset and the book value, obviously you will either have a gain or a loss. So if I have a piece of equipment in my business, I'm currently carrying it at book value, cost minus accumulated depreciation, and then I decide to donate it, I have to recognize an expense for the fair value of that asset. If the fair value is different from the book value, then I have a gain or loss. And the company that's receiving the equipment is recording the asset at fair value and crediting contribution revenue. All right, so that's all you need to know with donated assets. And again, if you end up, you know, as accountants, we could end up anywhere doing accounting, but if you end up in a non-profit, you know, doing accounting for them, you'll see a lot more of this type of accounting where donations or revenue and things like that. It feels a little bit weird because we're kind of used to the for-profit scenario. And also when you go to your four-year schools, you'll end up doing some type of or a little bit of a few chapters on nonprofit accounting. All right. And I mean, in New York, there's a ton of nonprofit organizations that you could end up working for. So just know that their accounting differs somewhat from the regular stuff that we see all the time. So those are the three small topics. I'm just going to go over a little bit exchange of non-monetary assets. And, I have a whole sheet prepared of examples that we will do on that. This does get a little bit hairy in terms of following the thinking around it. So, if you were close to being asleep before, please wake up. If you've been awake all along, that's great. Be even more awake now, because this part is a little bit I don't know, I'm feeling like maybe not unnecessarily, but it's a little bit complex. Okay, so just stick with me. In this scenario, I think the classic thing that you can think about if you want to think about day-to-day life, about exchange of non-monetary assets. And I know we're in New York, so people are predominantly on public transport, but I'm sure you may yourself or some family member may have had like a car in the past. And if you've ever traded in an old car for a new car, so let's say you had your sporty BMW that you drove for a while, and since you need to keep up your street cred, you decide that you need to buy a newer model. So instead of just kind of throwing the old car away or saying, I don't need it, or giving it away, you go to the dealership and you say, yeah, I have this 2019 BMW that I want to trade in, give in to you, and I want to be able to get a 2021 BMW in exchange. Then they will tell you how much that old BM is worth. You probably would have looked at whatever it is, Carfax or something, to see if the number they're giving you is reasonable. And the fair value of that old, old in quotes because it's only from 2019, but that old car will go towards, right, the purchase price of the new car. And then maybe there's some cash that not maybe, obviously you'll have to probably pay some amount of cash in addition to giving up your old car. But that's what we mean by the exchange of non-monetary assets. A company or an individual is exchanging one asset for another, maybe similar, it could even be a dissimilar asset, but there's this exchange. You have to think about, what's the value of the thing that you're giving up, try to determine the value of the thing that you're getting. Maybe there's cash paid or cash received. And so that's what's happening here. So if you ever get stuck in terms of trying to figure out what on earth is going on, just try and think about it in terms of, oh, if I'm giving up, one old car to get a new car and maybe paying some cash, or maybe you give up, I don't know if they do this with phones, it might be me fantasizing that this happens, but maybe you can give in an old phone and maybe they'll say it's worth X, we'll give you X dollars for it, and then you can buy a new phone, and the fair value of the old phone goes towards the cost of the new phone, right? That's another way of thinking about it. So the basic principle that is followed in non-monetary exchanges is to value the asset that you receive, right? Because there's an asset you're giving up and there's an asset that you receive. You value the asset that you receive at fair value. Now, it's not always obvious what the fair value of the asset that you receive is going to be, so you'll have to sometimes use calculations and formulas to come up with that amount. So the fair value of the asset that you receive can be based on the fair value of the asset that you give up, or the fair value of the assets received plus or minus any. cash exchanged, right? So again, because it's non-monetary assets, you may or may not have fair value numbers for these things, and there may also be cash involved. So we have rules around how you can calculate this. And just to be clear, it's a type of disposal that you're doing. You're getting rid of one thing, so you're getting rid of the cost of it, you're getting rid of the accumulated depreciation, you are receiving another asset, and you also may have a gain or a loss. Okay, so it's a type of disposal that we're doing, but we're not disposing of the asset for cash. We are disposing of the old asset and receiving a new asset in return. So if you still remember your disposals work from before, selling or retiring assets, it's that same thinking that we're in. In practice, we expect the fair value of total assets received to equal the fair value of total assets given up in a fair trade. And by assets, they mean the car plus money, or it's not just the car. So you can't say you expect the fair value of a new car to be the same as the fair value of the old car. That's not what we mean. We say if I'm getting a new 2021 BMW, the fair value of that BMW should be the same as the fair value of the old BMW plus whatever extra cash I have to pay. We recognize a gain or loss for the difference between the fair value and book value of the asset given up. So my 2019 BMW had a book value, cost minus accumulated depreciation is the book value. It also has a fair value based on what the dealership tells me the fair value is. So I can see how much I'm gaining or losing based on the difference between those two. That's pretty standard thinking. The amount of cash given or received has no effect on the amount of gain or loss recognized, because the gain or loss is calculated as fair value of the old asset minus the book value of the old asset. We'll do many examples and this will become clearer, but I do have to just go through the theory with you. Companies immediately recognize losses they incur on all exchanges. So if there's a loss, you're going to debit loss on exchange, and it will be recognized regardless of and this is where this word comes up, regardless of whether there's commercial substance to the transaction or not. And I'll tell you what commercial substance is in a minute. The accounting for gains depends on whether the exchange has commercial substance. So as usual, the FASB, the codification, they don't want companies to just create gains out of thin air. They actually want companies to be able to record losses if they're happening, but gains can only be if the exchange actually changes the cash flows of the company. So what do I mean by that? If I was commercial substance would mean something like what I was saying. I'm exchanging, a 2019 BMW that's been driven, quite a lot for a new 2021 BMW plus cash. The fact that I have a brand new car is going to change. Maybe I'm even driving Uber or Lyft or something. It's going to change the cash flows for me, in the sense that the amount of maintenance and things that I would have done on an older car with higher mileage is different from what's happening with a new car. I may be able to go further distances, etc., etc. Maybe the difference in the years is not enough, but let's just assume that there is a change in my cash flows as a result of the transaction, right? Whereas if I exchange a 2019 BM for another 2019 BM, maybe just with a little bit less mileage on it, that's not considered to have commercial substance, because what is really changing in my situation? Not much, right? So if that transaction ends up in a gain situation, I'm not allowed to record the gain, because what the FASB is trying to avoid is people doing exchanges amongst each other and generating gains that don't really exist, and then recording those gains and pushing up, right, their profits on their financial statements. So in your questions, they will state whether the transaction has commercial substance or not. And the takeaway, right, here's the takeaway. If you've now forgotten everything I just said, right? Which is fine, because we'll go over it again. But the takeaway is all losses are recorded, regardless of whether the transaction has commercial substance or not. Gains on an exchange are only recorded if the transaction has commercial substance. That's what you need to take away from, from the discussion around gains and losses. I'm going to leave it there for now. I want to just say that if you were part of the group of people who download, the documents that I give, I did, based on a call that I had with one of your colleagues yesterday in the office hours, I actually made some changes to the non-monetary exchanges handout. I revised it. So this document has been revised. The document looks, the document looks like this. But I highlighted here in yellow where there were places where I made some changes. So please, if you already downloaded that, just download it again. And then also on our actual handout for class, I decided to be, just based on the conversation that I was having with your classmate, I realized that I needed to give a few more examples that were a little bit more structured, incrementally structured in terms of the work that we're doing for non-monetary exchanges. So I replaced questions 5 through 8, which were all separate examples and didn't really flow systematically. I replaced it with non-monetary exchange examples that actually go systematically through, exchanges with commercial substance, loss or gain, exchanges that don't have commercial substance, exchanges where you receive money, and so on. So we'll go through all of that, next week. Don't worry too much about that now. If you want to read through it, you're welcome to do that. I guess I just want to make sure that for the people who are, downloading things, that you actually download the chapter 10 notes again, because I literally just uploaded last night with the changes, and then also this exchange handout and the solution. These last 3 things have been updated and they are new. All right, so that's for your records if you need it. I'm going to one last time put the Zoom meeting for the Reg Hour into the chat, the meeting information. You guys can copy from there if you don't. That question was already answered. If you don't have the meeting ID, remember we're all going to get on there just before 1 or around 1 to listen to Professor Maharaj, and I'll see you then. What else can I say? The test is open. I'm here for help. I'll stick around until about 12:50 on this call. If people have questions about the test or the quiz, happy to answer them. Otherwise, you're dismissed, but please join the Reg Hour call at 1 p.m. Thanks, everyone.